Good morning. It's Thursday, the 10th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital, where it is begun raining again. The take: why is Nestle hiring an ex-Amazon person? The first assignment for fresh management trainees in Hindustan Unilever, or HUL, would usually be to spend about 2 months in a small and remote village like Etah in Uttar Pradesh. It's an era most FMCG or fast-moving consumer good veterans from HUL and also heading other organizations now fondly recall, mostly for how it's shaped their outlook and understanding of the Indian consumer. But what happens when the consumer and the distribution pipeline start shifting as they are now from physical to digital or a complex hybrid of both? Nestle India, maker of Maggi and Kit Kat, has hired a replacement for 26-year-old company veteran Suresh Narayanan, who retires next year. Interestingly, the incoming CEO's last job was with Amazon for 8 years, though he worked with Unilever for about 20 years before that. The Amazon part may not be a coincidence. Now, there are two interesting themes at play in this succession playing out for Nestle's top job, that's Nestle India. Firstly, Nestle has chosen to go for an outsider. Now, this is unusual for multinationals like Nestle, Levers, and Procter & Gamble, among others, particularly in the consumer product space that I've seen. More so because these companies pride themselves on their internal growth and succession pathways, which kick in almost the day a management trainee steps into the office. To skip that internal succession route would suggest that Nestle feels it needs skills the company might not have internally right now. Following from that, the new hire comes from Amazon and not, for example, another consumer products company which sells a similar suite of products. So it's the e-commerce experience that's presumably at play here, apart from all the other constant factors of brand, market, and consumer experience. Now, this is a different world from the early days of an HUL management trainee that I talked about earlier. HUL's Etah ritual probably started in 1979, just as a flashback, when then Chairman T. Thomas sent management trainees to stay there for 2 months to instill confidence amongst villagers to adopt artificial insemination of cows to improve milk yield. Sudhir Sitapati, now CEO of Godrej Consumer, writes of how when he joined HUL in 2000, he and his batchmate were sent to Etah and their hosts were a poor farming family in Bakarai village. Former HUL chairman MS Panga once reminisced to me about taking open-air cold water baths in Etah as a management trainee. Now, most consumer product companies would most likely have similar initiation rituals for their managers, given that this is the part of India where the bulk of their consumers reside, whether for soaps, personal care, beauty, or foods. But digital-savvy consumers are increasingly likely to consume differently, even if they are in the same physical locations. India has, as you know, perhaps 800, maybe more million internet-enabled smartphones with a robust payment system for transactions and the logistics infrastructure to deliver to most places or PIN codes. Significantly, for both HUL and Nestle, the share of e-commerce to total sales is growing and currently stands around 7%. HUL CEO Rohit Java said recently that e-commerce was growing faster than modern trade and modern trade is outpacing general trade, a trend that, in his words, seemed secular. E-commerce is segmenting into different models, including beauty commerce, grocery commerce, and quick commerce, he further told website Money Control. Nestle said a few months ago that its e-commerce business continued to accelerate with significant growth in quick commerce along with click and mortar, driven by brands like Kit Kat, Maggi Noodles, among others. Now, this is not to say that a stay in Etah will not be useful or productive for a management trainee in a consumer products company. But what they will try and learn in these places is likely to be different from their predecessors a few decades ago, a different lens and approach to selling. In an earlier era, you had brand managers who focused on brand marketing, propositions, and then a distribution tail which included warehouses and distributors. The structure of this somewhat goes back to the pre-GST era when states had different local taxes and transport of goods was highly constrained. But in the new era where direct channels are growing, the nature of distribution and marketing is changing fast. For example, there was no role for influencers earlier because sales were driven by, let's say, physical outreach campaigns, including in-shop posters, pamphlets, and other merchandise, or conventional media like television and print advertising. The new consumer product company CEOs obviously have to think differently and perhaps unlearn many of the things that brought them to their current position, because the new markets have to be driven by understanding and execution that is and has to be driven top-down. Now, the realization is obviously there already, but the change will take longer to come. And Nestle's hire is a sign of times to come. And that brings us to the top stories and themes of the day. The stock markets retreat after gaining as weakness persists. Interest rates unchanged for the 10th consecutive time. Oil prices slip again on weak demand and China stimulus disappointments. It's the festive season, but gold buying in India is slowing as prices hit record highs. And new formats for recognizing climate risk in the financial system are coming.
This is the Core Report with Govindraj Ethiraj.
Markets slip again. The stock markets opened strong and then slipped as buying support was evidently weak and sellers were still calling the shots on Wednesday. The Sensex fell about 167 points to close at 81,467, while the Nifty 50 was down around 31 points to close at 24,981. Interestingly, while China portfolio flows are now wavering as investors are holding out for more SOPs or stimulus measures, that's not helping the Indian markets, at least for now. The Reserve Bank of India kept the repo rate unchanged at 6.5% for the 10th consecutive term, and more on that shortly. The spoiled Chinese markets. Now, stock markets in general can act like spoiled children whose needs cannot be satisfied with a single bar of chocolate. Chinese stocks listed onshore suffered their biggest drop in more than 4 years as traders grew impatient over the pace of Beijing's stimulus measures and weak holiday spending data hit sentiment, according to Bloomberg. The CSI 300 index, that's the mainland index, fell about 7%, erasing its advance from Tuesday when mainland markets reopened after the Golden Week holidays. The gauge held somewhat after the Ministry of Finance said it would hold a briefing on fiscal policy, and then selling pressure resumed to lead the first loss in 11 days, Bloomberg reported, adding that an index of Chinese stocks listed in Hong Kong fell further after sliding more than 10% on Tuesday. Earlier, the National Development and Reform Commission, which is China's economic planning agency, used the government's first briefing after that holiday to announce a roughly $28 billion spending that will be advanced from next year. That's 200 billion yuan. Analysts, however, forecasting a fiscal package worth more than 3 trillion yuan, or more than 10 times that, in the pipeline, according to Bloomberg. I don't know what the chairman of the NDRC was thinking with this. Alicia Garcia, Asia Pacific chief economist at Natixis SA, told Bloomberg a little after that briefing. The point is that the markets are looking for a fiscal stimulus, or more simply, hard cash. Frankly, the more they wait to clarify, the worse it can be, because people will realize there is no fiscal side to this stimulus and that it's all monetary, propping up stocks and so on, and that's dangerous, analysts told Bloomberg. Iron ore, base metals, and oil prices fell, and more on oil shortly. All of this means, of course, that China will be in play for longer as a market that will potentially pull more capital away from other parts of the world, and most notably India, but that may be on pause, at least momentarily. Oil prices fall again. Meanwhile, oil prices also fell after China's NDRC did not provide those fresh stimulus measures, which also illustrated once again how important the demand side of the equation is and how weak that demand is, particularly in China, the largest importer of crude in the world. On the other hand, we're still seeing and facing heightened risk in the Middle East, and markets still expecting and anticipating a strike by Israel on Iran's oil facilities. All of that is obviously not balancing out the weakness in demand. Global benchmark Brent crude and US benchmark West Texas Intermediate have both lost about 5% in prices in the last few days. Iron ore and base metals fell following the NDRC's comments. Hong Kong shares had their worst day since 2008, falling almost 10%, as we just pointed out. Chinese officials said that they would speed up spending while largely reiterating plans to boost investment. A senior energy trader at CIBC Private Wealth Group told Bloomberg that geopolitical premiums tend to fade as fewer headlines emerge, even while or when underlying risks remain present. Gold prices keep shooting. With Dussehra around the corner and Diwali a little further down, all of it in this month, gold buying typically would step up at this time of the year. But that's looking difficult because gold prices have now hit a record peak again, and also a sign of strong demand. Remember, prices had come down after import duty cuts in the July union budget. The duty cuts from 15 to 6% brought local prices down to a 4-month low of 67,400 rupees per 10 grams. Since then, they've risen about 13% to hit a record high of 76,331 rupees. The president of the India Bullion and Jewelers Association told Reuters that with prices bouncing back before the festivals, demand might end up being 20% lower than usual in terms of volume. They also said that buying habits were shifting, with consumers spreading their purchases throughout the year and focusing on price rather than waiting for specific occasions. Reuters also says India's gold imports jumped more than 200% in August versus the previous month to 136 tons as jewelers anticipated strong festive demand. However, the subsequent price surge has also led imports to drop to 60 tons in September, according to estimates. Meanwhile, gold prices have softened in international markets overnight as traders watched US macroeconomic data. Let's see what happens to the Indian markets in the next few days. Interest rates unchanged. The Reserve Bank of India on Wednesday kept the repo rate unchanged for the 10th consecutive time at 6.5%, but changed its monetary policy stance somewhat from withdrawal of accommodation to neutral. This was, of course, no surprise at all. The Reserve Bank of India Governor Shaktikanta Das said in his statement that despite the change in stance, the six-member Monetary Policy Committee remains focused on bringing the headline inflation to 4% on a durable basis. 5 of 6 members voted in favor of holding rates, the Business Standard reported. The Reserve Bank said that keeping in view the prevailing and expected inflation growth dynamics, which are well balanced, the MPC decided to change the monetary policy stance from withdrawal of accommodation to neutral and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. According to the Reserve Bank, a change in stance, or the change in stance, provides flexibility to the Monetary Policy Committee while enabling it to monitor the progress on disinflation, which is still incomplete. The Reserve Bank also says it remains mindful of risks to inflation in the months ahead, which I'm guessing is mostly food. It's also highlighted adverse weather conditions, ongoing geopolitical conflicts, and a rise in select commodities as the key threats to its inflation forecast. And all eyes now are on a potential rate cut in December, even as concerns, like I said, remain on food price inflation. Rating agency CRISIL said the Reserve Bank of India has adopted a neutral stance but kept the policy rate unchanged. And while this signals circumspection, it also underscores the likelihood of a rate cut in December. CRISIL also said that it's obvious that high food inflation is constraining Mint Road, the name or the term used to describe Reserve Bank's headquarters. To be sure, non-food inflation has stayed significantly below trend at 2.3% in the first 5 months of the current fiscal. CRISIL said, also adding that the outsized US Federal Reserve rate cut of 50 basis points last month marked a complete and decisive turn in monetary policy amongst major central banks. CRISIL said they anticipated a 25 basis point reduction in the repo rate during the policy review in December in response to the expectation that food inflation will decline. I reached out to Vivek Kumar, economist with Quanteco Research, and I began by asking him how he was seeing the Reserve Bank of India's stance, particularly in context of how central banks like the Federal Reserve were reducing rates.
Yes, as you rightly said, the pause on repo rate continues while there has been a shift in the policy stance from withdrawal of accommodation to neutral now. Now, essentially what it means is that the RBI as a rate setting body is now going to look at both inflation and growth, basically the balance, in a more neutral perspective. Earlier, as you can recall, the focus was primarily on aligning inflation to the target. It's not that the objective has been done away with. I think what the governor tried to emphasize in the policy press conference was that a large part of that battle against inflation has been won. And it's now a matter of fine tuning. It's now a matter of alignment with the exact target. So if you notice, for the first time in the post-COVID phase, the RBI's average of 4 quarter ahead inflation has dipped below 4.5%. While I know there is an exorbitant amount of focus on what the RBI is forecasting for the year as a whole. So for example, FY25, people do talk about the 7.2% GDP growth number, 4.5% CPI inflation. But from an MPC perspective, I think the forward-looking estimates on a 4 quarter rolling basis. Basically, what they do is look at 1 year ahead, what is the picture looking like? And the forecast for FY25 have just about half shelf life now left with them. It makes more sense to go beyond FY25 and take a peek as to what kind of thought processes RBI adopting. And here we notice that for the first time, the inflation forecasts have dipped below 4.5%. So that is, at least for us, a clear indication of some success in terms of aligning the inflation with the 4% target. And this is happening at a time, Govind, where willy-nilly there is some downside risk to growth which has emerged, although RBI, we do accept that they have not put it in terms of numbers. And they have not also talked about in terms of risks because their forecast continues to remain at 7.2% GDP growth. In fact, even the Q1 number of GDP for the next financial year is still more than 7% as far as RBI is concerned. They have not really factored that in, but given how globally things have changed in the last 1 month, especially the elevated nature of geopolitical disruption, the downside risks to global growth is something that is now pretty much active and pretty much on the table. That needs to be taken into account. There are also some very nascent signs of slowdown in the Indian economy. If you look at the last 1 month of high frequency real activity economic indicators. For example, core sector data that was negative. PMIs, while yes, we do accept that the levels are still healthy, but nevertheless, they are decelerating. No doubt the levels per se are still healthy, but there is a deceleration. And even the tax collection, for example, GST, e-way bills, they are now showing some deceleration. Not entirely unexpected, because if you see where the market forecasts are, market is a tad below RBI in terms of the current year's GDP growth projection, even for next financial year. So RBI doesn't give any forecast for FY26, but if you look at the monetary policy report, which comes out biannually, there they have a model-based estimate for GDP growth as well as for CPI inflation. And that model-based estimate still talks about a 7% plus GDP growth in FY26. And the market consensus on FY26 GDP growth is even lower at somewhere close to 6.6, 6.7. So there is a gap between market's estimate or market's perception on growth and RBI's own perception on growth, or at least the anticipation. And this, at least as far as we are concerned, we believe will be one of the prime factors why the current shift in stance makes sense in an unsaid way. It hasn't been said, but this is what probably means. And last but not the least, Govind, there is a lot which has happened on the global monetary policy front in the last 1 month, starting with the Federal Reserve. And not just Federal Reserve, now it's gone much beyond that. We did a very interesting exercise where we studied the rate movement of more than 150 central banks across the globe. And what we found was that this is the third time in the history that the number of central banks easing their monetary policy is the highest. So it kind of looks like a coordinated central bank easing across the globe. And this is the highest since the global financial crisis. The previous high was during COVID. That was understandably so. After that, the global financial crisis, and it's the current episode, which is the third highest in the history of central banks easing their monetary policy. So a lot has changed, and RBI is also kind of somewhere hedging that risk by stating that the neutral policy is much more appropriate. It gives them time, it gives them a flexibility to move in either direction. Withdrawal of accommodation stance was slightly more unflexible, slightly more rigid in comparison, and the degrees of freedom were much more restricted in the earlier stance.
Right. Last question. If looking at all this, I mean, you've talked about some of the indicators not looking so good and some slowdown setting in. What's your sense? I mean, what should the monetary policy ideally be from your perspective, regardless of what the Reserve Bank does?
So from our perspective, I think, half of the financial year is already behind us now. And the kind of momentum that is probably in store, we should be able to hit somewhere close to the 7% GDP growth mark in the current. The risk would probably be much more concerning for FY26, because that is where adverse impact of geopolitical disruptions plus the likelihood of a political change in the US, which raises many questions on the global trade front as well. So all this would probably start manifesting in FY26 rather than FY25. And monetary policy, we all know, works with long lags. So whatever RBI does now on the interest rate side will have an impact on both real activity as well as inflation indicators, maybe 4 quarters down the line. So that is the kind of lag which typically is associated with the transmission of monetary policy to economic variables. So we would ideally expect RBI to start acknowledging some of these risks and start pruning their monetary policy rate with respect to the expected inflation, which is expected to moderate further in next financial year, and in fact start taking into account some of the growth risks on the table as well. So according to us, if we have to take a 4 quarter ahead or a 6 quarter ahead view, then one should ideally start calibrating the monetary policy rate lower.
Vivek, thank you so much for joining me.
It's a pleasure, Go. Thank you.
Climate risk to the financial system. In a sign and recognition of the importance of climate risk to businesses and projects in specific and the financial system in general, the Reserve Bank of India has said that climate change is emerging as a significant risk to the financial system. It has also argued for regulated entities like banks to undertake climate risk assessments for ensuring stability of their balance sheets and that of the financial system. Such an assessment requires, among other things, high-quality data relating to local climate scenarios, climate forecasts, and emissions. The problem, the Reserve Bank of India says, is that the available climate-related data is characterized by various gaps, such as fragmented and varied sources, differing formats, frequencies, and units. To bridge all these gaps, the Reserve Bank of India has proposed to create a data repository, namely the Reserve Bank Climate Risk Information System, or RB-CRIS, comprising two parts. The first is a web-based directory listing various data sources, meteorological, geospatial, which will be publicly accessible, and the second will be a data portal comprising datasets, which will be available only to the regulated entities in a phased manner. Google could get split up. It's early days, but the US Justice Department is considering asking a federal judge to force Google to sell off parts of its business in what could be a historic breakup of one of the world's biggest tech companies, according to Bloomberg. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.